Going to be very brief with the introduction here. We have a lot of interesting ground to cover tonight, and so gonna do the best that we can to get to that information. So thanks again for being here. Let me just give you a little bit of background. So went to Tufts for undergrad. I know a lot of you guys know me either directly or through my mom or other friends. Spent the majority of my early career in high tech and telecom, and then went back to get a business degree. Thought that would be a good idea, and ultimately ended up in the medical device space where I worked in sales and strategic marketing for the better part of my career. During the majority of this time, there was one thing that was actually consistent, and that was a constant investment in real estate. No matter what we were doing, we were always looking for the little houses and one day, hopefully, the little hotels. And really the rationale for that speaks to the second part of my background and probably the most important, well, definitely the most important, which is my family. So this is my beautiful wife, Michelle, my two little kids, Max, who's 2.5, and Milana, who just turned 1, and of course my mom, who happens to be here in the studio audience tonight with us, and is really a big part of why this entire venture came about. So next slide. I think you might want to close that. Can we close the... So Mom came to the U.S. from the Soviet Union with me, a couple $100 in her pocket and in a suitcase, and quickly worked her way up the corporate ladder, basically from nothing. She found herself rubbing elbows with some pretty important people. This is former Russian President Boris Yeltsin. This photograph needs no introduction. You can see Hillary kind of giving her a little bit of an evil eye there. But while my mom's career track was going in an uphill direction, she was kind of following the basic American financial prescription for success, which is, you know, put your head down, focus, work hard. She's putting in 15-hour days. Diversify your savings in your 401k, your company's stock plan that they match. Meet with your financial advisor a couple times a year, and everything is going to work out fine. You know, just stick with it for the long run. That was going great until something in that plan cracked, and you have to have a little bit of context to know that my mom's peak earning years were really in the late 80s and really throughout the 90s. And we had never seen anything like what was about to happen, which was the dot-com bust of 1999 through 2001. And at that time, my mom lost a very significant chunk of her portfolio, which was also poorly timed because that was around the time that she retired from corporate America. Now, I was fairly early in my professional career, but this left a very lasting and meaningful impression on me. And honestly, I was rattled. I was like, how could this happen? Just because a few people over the course of several months invested in some bad companies that didn't even have any revenue. Somebody like my mom could lose 30% of her life savings in a very short time. And I kind of came to an epiphany, which was more of like a nagging voice in my mind. And I said, you know, aside from putting my money in my company's 401k and buying these paper assets, I'm also going to begin collecting stuff that I understand, assets that are real, and ones that can't be taken away in a bubble full of air. So two things started happening. My wife, who was my girlfriend at that time, and I decided that we were going to begin acquiring homes, at least one a year, distressed single-family homes and condos. And this is and then, you know, turning them around, fixing them and renting them out, and trying to drive an income stream. And we did this all over the country: Texas, California, Colorado, and even a project in Mexico. And the second thing, over a couple of years, decided to go back to B school, trying to enhance and further deepen my business and financial education, thinking that maybe there was some secret sauce, some tribal knowledge that I just didn't know. And that if I just went out and acquired it, it would help me to mitigate and protect from these type of circumstances happening to my own family. So when it comes to the market, I can sum up what I've learned really in just one sentence, which: this ain't your daddy's stock market. This headline captures it really well, and it says, market volatility is back and here to stay. The reality is that the stock market of the 21st century and beyond bears very little resemblance to the market of the 20th century and before. There's so many extraneous factors outside the control of us as retail investors. Things like, intercontinental and multi-country conflicts, like when the U.S. invaded Syria, or Greece about to default on its government debt, and that causing a 5% spiral of the market. Things like high-speed computer algorithms responsible for the majority of trading that happens in the world today. The reality is it's very difficult to control or predict what is actually happening in the equities world. So this view was forever solidified in my mind when the same thing happened to me that happened to my mom in 2001 and 2008, when the housing bubble caused the second biggest market crash since the Great Depression. And in our minds, we're kind of trained and conditioned to think of a slope like this. Stick it out over the long run, 6 to 8%. That's about where you should be. It'll all even out. But depending on when you need the money, depending on when your peak earning years are, if you happen to be peak investing between 1996 and March of 2009, your compound annual growth rate was exactly 0.33% if you did the math in March. And so that's scary because the trend line isn't necessarily representative of our entire investing lifespans for all of us. So I came to kind of what I call a second epiphany, if you will, which was that really, despite my background, I had my family's future invested in assets that I didn't truly understand and really couldn't predict at all. And so we came up with a very short list of investment goals. The first one was to diversify into asset classes that we understood and things that were rooted in knowable trends that we saw around us. The second was to invest in assets that offer a significant growth component and also a cash flow component. A lot of times you're either a dividend investor or a growth investor, right? When you go to Morningstar and you talk to your mutual fund advisor, they say, well, what do you want? You want income or do you want growth? Because to have both is kind of like having your cake and eat it too. And then rather than hoping for our nest egg to grow and provide income one day, we wanted to seek out investments that would provide income today. So having recently moved to San Diego and living in, basically a year-round paradise and kind of being pretty attuned to the baby boomer wave, since my wife and I had both worked in the healthcare and medical device industry, one thing that we understood was that people wanted to go on vacation, and they always will. So we bought a dilapidated duplex back in 2008, which over time morphed into a very healthy portfolio of 10 vacation rental properties that provided income, substantial income, enough for my wife to leave her job, and more importantly, diversification. There's nothing like driving by a triplex or a fourplex, seeing the lights on and cars in the driveway, and knowing that those are folks that are paying you to stay at your home. So that was a very powerful educational experience. And people say, well, hey, why don't you just keep doing what you're doing? I mean, if that works, if it ain't broke, why try to fix it? Well, as we all know, the Fed's been printing $85 billion per month for the better part of the past 2 years under the quantitative easing program. And so what that's done is it's kept interest rates low. Stocks are up, right? We're all feeling pretty good about 2013, and we all feel a little bit richer. So what that's done to real estate prices is it brought them back to almost bubble-like levels, where it's very difficult to know whether the underlying price that you pay for a piece of property is truly reflective of its value. I don't know that a house I buy today in Orange County or San Diego is going to be worth less, more, or about the same 10 years from now. So the projects I showed you earlier, for sure they have an income component, but when you went out and went real estate shopping, the people that you're bidding against are other people looking for income too. And they don't really care about what the price is. They care about what the monthly mortgage is. And that's a function of interest rates, which is scary. So we revised our goals a little bit based on what we had learned in the prior 5 years and added a couple of corollaries to them. The first one was that we wanted to reduce correlation to the volatility in the U.S. market by investing close to the U.S., but not necessarily within the borders of the U.S. Secondly, we wanted to minimize our risk to inflation, because it's really hard to rationalize that the $100 grand that I have in my bank account today is worth the exact same as it was 2 years ago before the government started printing $85 billion. And of course, we all know that the dollar is no longer really tethered to any type of real underlying asset. We abandoned the gold standard in 1971, so the printing presses can roll pretty much with, unfettered abandon. And third and finally, we wanted to find an opportunity that was in the right place at the right time and kind of finally be ahead of the curve rather than right in the thick of it when everybody else was doing the same thing. So for a bunch of reasons over the next 18 months that we'll get into in our next speaker's presentation, our research took us to Central America. And we got on a plane a couple times and really went on a grand tour in search for the Holy Grail. We went to Mexico, looked at some properties there. We went to Costa Rica. We went to Panama. Looked something like this. In terms of opportunity, that looks like San Diego or Miami. Not a lot of growth and development opportunity there. And at the end of the day, based on the list of criteria that we had come up with, all roads ended up continuously leading to Belize, and more specifically, the picturesque island of Ambergris Caye. And so it's my distinct pleasure and honor to have with us today a guest who is going to really tell us all about why Ambergris Caye. That's sort of the question that we're answering, that we're asking ourselves. And so Mr. John Turley, a good friend of mine, just a little bit of background. I could go down a laundry list of accolades, but these are the ones from 2012, because I think the RE/MAX Awards ceremony for 2013 is next week in Vegas, so we don't have the official stats yet. But for 2012, John had the #1 brokerage in the country of Belize. He was the #1 agent for RE/MAX in the Caribbean. He was #2 international RE/MAX agent globally, which made him in the top 20 out of 90,000 worldwide. And John knows more about international real estate investing than just about anybody else I've known. And to boot, he's a really great guy. So with that, I'd like to introduce Mr. John Turley.